everyone, today I am Muhammad Nur Iman bin Abdul Fattah will introduce you guys about Sime Darby Berhad and DRB Berhad. Sime Darby Berhad is one of the largest company in Malaysia. It was founded in 1910 by William Sime and Henry Darby. Originally, the company started as a rubber plantation business in Malaya before expanding into various industries. In 2007, Sime Darby merged with Golden Hope Plantation Berhad and Guthrie Berhad under the Synergy Drive initiative, creating one of Malaysia's largest corporation. After its restructuring in 2017, Sime Darby focused on its core businesses, including industrial equipment, automotive, logistics, and healthcare services. Today, the company continued to strengthen its position through strategic growth and operational efficiency. Next is DRB Highcom Berhad. DRB Highcom is one of Malaysia's leading diversified corporations. The company was established in 1996 through the merge of Highcom and Diversified Resource Berhad. The group operates in several sectors including automotive, aerospace and defense, water services, banking, and property development. DRB Highcom is well known for its involvement in the automotive industry through brands such as Proton, Modenas. The company continued to focus on sustainable growth and long-term value creation.
Assalamualaikum and hello everyone. Today we will look into 5-year financial trend analysis comparing two major corporate company, Sime Darby and DRB Highcom. We will evaluate their liquidity position and leverage structure to see how well these companies manage their short-term obligation and long-term debt. Alright, let's begin with the liquidity, starting with the current ratio for Sime Darby. In 2021, Sime Darby started strong with a current ratio of 1.63 times, which peaked slightly at 1.65 times in 2022. However, it dipped to lowest point of 1.42 times in 2024. It is because current liability outpaced their current assets, indicating heavy reliance on short-term funding. Fortunately, by 2025, it is a rebound clean back to 1.57 times. Overall, it is a ratio remains safely above 1.0 throughout the 5 years. Now we turn to DRB Highcom. We see a different narrative. DRB Highcom had a stable current ratio of 1.23 times in both 2021 and 2022. From there, it is experienced a steady decline, but it is dropping to 1.19 across 2024 and 2025. While DRB Highcom consistently maintained enough short-term asset to cover its debts, staying above 1.0, short, it is a liquidity position has gradually weakened over the years. To get a straighter view of liquidity, let's strip away inventory and look at the quick ratio. Sime Darby quick ratio initially dipped from 0.60 in 2021 to 0.50 in 2022 and 2023, showcasing a heavy reliance on inventory sales to meet immediate commitments. However, in 2025 brought a sharp and highly positive recovery up to 0.72. Even though it is slightly below the standard 1.0 benchmark, the upward trend shows a major boost in their immediate cash conversion capability. In contrast, let's look at the DRB Highcom quick ratio. This chart shows a concerning continuous downward trend over the 5 years period. Starting to at 0.44 in 2021, it is shrank every single year, hitting a low of 0.32 by 2025. It is because these numbers are significantly below 1.0. It highlights that the DRB Highcom could face short-term financial flexibility constraint and it forced to cover immediate debts without relying on inventory liquidations. Now we moving on to capital leverage. Let's analyze the debt ratio, which shows that what percentage of assets are financed by debt. Looking at Sime Darby, their ratio fluctuates tightly between 0.45 and 0.54 times. It is peaked in 2024 at 0.54 times and stabilized down to 0.50 times in 2025. This tells us that roughly half of Sundabi's assets are funded by liabilities and pointing to a well-balanced management debt level. For DRB Highcoms Company, debt ratio tells a more debt-heavy story. As shown, their debt ratio rose steadily from a low of 0.76 in 2021 up to 0.83 in 2024 and 2025. This steady upward trend highlights that DRB Highcom has increasingly relied on creditors to fund its asset base, leaving it more exposed to leverage risks. Let's look at the debt to equity ratio comparing total liabilities directly to shareholders' equity. For Sundabi illustrates a pronounced multi-year peak starting at 0.879 in 2021. It climbed significantly to 1.209 in 2024 as liabilities temporarily outpaced equity. However, a strong correction in 2025 brought it back down to 1.031, moving toward a much more balanced capital position. Now we can continue. Let's evaluate DRB Highcom's debt to equity ratio. The graph displays an aggressive and continuous upward trajectory. It is started at 3.74 in 2021, surged past 5.05 in 2024, and reached its highest peak of 5.07 in 2025, with total liabilities reaching 24.94 billion against the just 10.82 billion in equity. This underlines intensely heavily reliance on debt relative to equity base. To the conclusion, both companies have successfully navigated their short-term obligation over the past 5 years. Sundabi exhibit a healthier financial profile with a stronger liquidity safety nets and a well-balanced debt structure. For the DRB Highcom, on the other hand, shows weakening liquidity trend and aggressive reliance on debt financing, signaling a clear need for tighter asset liability management moving forward.
Good day everyone. In this section, I will present the activity ratio analysis of Sundabi and DRB Highcom from 2021 to 2025. The four ratios used in this analysis are inventory turnover ratio, receivables turnover ratio, total asset turnover ratio, and fixed asset turnover ratio. First, I will explain the inventory turnover ratio. For Sundabi, the inventory turnover ratio decreased from 4.9 times in 2021 to 4.3 times in 2022, and further declined to 3.6 times in 2023. This downward trend may indicate that inventory was moving more slowly during this period, or that the company held higher levels of inventory relative to its cost of goods sold. However, the ratio improved to 4.1 times in 2024 and 4.3 times in 2025. This recovery indicates an improvement in inventory movement and suggests that the company became more efficient in managing and converting its inventory into sales. Meanwhile, DRB Highcom recorded an inventory turnover ratio of 6.1 times in 2021, which increased to 6.6 times in 2022. The increase may indicate stronger inventory movement, more efficient inventory management. However, the ratio declined to 5.6 times in 2023, which may suggest slower inventory movement during that year. The ratio then recovered to 6.2 times in 2024 and 6.5 times in 2025. This improvement indicates that DRB Highcom became more efficient in managing and selling its inventory. Overall, DRB Hicom recorded a higher inventory turnover ratio than Sime Darby throughout the 5-year period, indicating a stronger inventory management efficiency. Excuse me. Next is the receivables turnover ratio. Sime Darby's receivables turnover ratio showed a continuous declining trend. The ratio decreased from 15.6 times in 2021 to 13.9 times in 2022, 13.7 times in 2023, and 30.5 times in 2024, and finally 12.0 times in 2025. The continuous decline may indicate that Sime Darby was taking a longer time to collect outstanding payments from its customers, or that receivables were growing faster than sales. However, the ratio remained relatively high throughout the period, indicating that the company was still effective in managing and collecting its receivables. For the RB Hicom, the receivables turnover ratio increased from 1.7 times in 2021 to 2.0 times in 2022. It then decreased slightly to 1.9 times in both 2023 and 2024 before increasing to 2.3 times in 2025. The improvement in 2025 may indicate that the company collected its outstanding receivables more quickly or managed its credit collection more effectively. However, when comparing the two companies, Sime Darby recorded a significantly higher receivables turnover ratio throughout the period. Therefore, Sime Darby demonstrated stronger receivables management and collection efficiency. Moving on to the total asset turnover ratio. For Sime Darby, the ratio decreased from 1.56 times in 2021 to 1.41 times in 2022 and further declined to 1.30 times in 2023. It remained at 1.30 times in 2024 before recovering to 1.48 times in 2025. The decline from 2021 to 2023 may indicate that the company's asset base increased faster than sales generated from those assets. In other words, the company was generating less revenue for each unit of assets during this period. However, the improvement to 1.48 times in 2025 suggests that the asset utilization and improvement in the company's ability to generate sales from its total assets. For DRB Hicom, the total asset turnover ratio remained relatively stable throughout the 5-year period. The ratio was 0.26 times in 2021, increased to 0.30 times in 2022, decreased to 0.27 times in 2023, and remained at 0.26 times in both 2024 and 2025. The limited change suggests that the company's efficiency in using its total assets to generate revenue remained relatively consistent. However, its ratio was significantly lower than Sime Darby's ratio. Therefore, Sime Darby was more efficient in utilizing its total assets to generate sales revenue throughout the period. Lastly, I will explain the fixed asset turnover ratio. Sime Darby recorded a fixed asset turnover ratio of 5.3 times in both 2021 and 2022. The ratio then gradually declined to 5.2 times in 2023, 5.1 times in 2024, and 4.5 times in 2025. The declining trend may indicate that the company's investment in fixed assets increased faster than the revenue generated from those assets. This suggests a gradual reduction in fixed asset utilization efficiency. However, despite the decline, Sime Darby's fixed asset turnover ratio remained relatively high throughout the 5-year period. In contrast, DRB Hicom showed a continuous improvement in its fixed asset turnover ratio. The ratio increased from 2.1 times in 2021 to 2.8 times in 2022, 3.0 times in 2023, and 3.1 times in 2024, and finally 3.3 times in 2025. This upward trend indicates that DRB Hicom continuously improve its ability to generate revenue from its fixed assets. The company may have achieved better utilization of its existing property, plant, equipment, and other fixed assets over the period. In conclusion, both companies demonstrated different strengths in their activity ratio performance from 2021 to 2025. DRB Hicom performed better in inventory turnover ratio, indicating stronger inventory management efficiency. However, Sime Darby performed better in receivables turnover ratio, total asset turnover ratio, and fixed asset turnover ratio. This indicates stronger efficiency in collecting receivables and utilizing both total and fixed assets to generate revenue. Therefore, based on the overall activity ratio analysis, Sime Darby demonstrated better overall operational efficiency during the 5-year period, while DRB Hicom showed stronger inventory management and continuous improvement in its fixed asset utilization.
Profitability ratio analysis. Now I will explain the operating margin for Sime Darby. The operating margin ratio is calculated by dividing operating profit by revenue and multiply by 100%. The operating margin for Sime Darby was 4.87 in 2021, 4.12 in 2022, 4.18 in 2023, 3.72 in 2024, 4.39 in 2025. From the chart, we can see that the operating margin decreased from 4.87 in 2021 to 4.12 in 2022. This decline was mainly caused by supply chain disruptions and operating costs. In 2023, the ratio improved slightly to 4.18, showing better cost management and operational efficiency. However, in 2024, the margin dropped again to 3.72, even though revenue increased. This indicates that operating expenses increased faster than revenue. Finally, in 2025, the operating margin recovered to 4.39, suggesting improved cost control and stronger operational performance. Overall, Sime Darby maintained a relatively stable operating margin through the 5-year period, demonstrating consistent profit. Next, I will discuss the operating margin ratio for DRB Hicom. The operating margin for DRB Hicom was 0.10 in 2021, 2.66 in 2022, 2.79 in 2023, 1.73 in 2024, 3.89 in 2025. The company recorded a significant increase from 0.10 in 2021 to 2.66 in 2022. This improvement was mainly due to the recovery of automotive industry after the COVID-19 pandemic and stronger vehicle sales. In 2023, the operating margin increased slightly to 2.79, indicating continued improvement in profitability. However, the ratio decreased to 1.73 in 2024 because operating expenses increased at faster rate than revenue. In 2025, the operating margin recovered strongly to 3.86, reflecting better cost management and improved operational efficiency. Overall, DRB Hicom showed a strong growth trend in profitability compared to previous year. For conclusion, both Sime Darby and DRB Hicom experienced fluctuations in their operating margins between 2021 and 2025. Sime Darby maintained a more stable profitability performance, while DRB Highcom showed greatest improvement and stronger growth over the 5-year periods.
Assalamualaikum and good morning to our lecturer and fellow classmates. Today, I will be presenting the profitability ratio analysis of Sime Darby Berhad and DRB Highcom Berhad from 2021 to 2025. Profitability ratios are important because they are measure how effectively a company generates profit from its revenue and asset. In this presentation, I will focus on two key ratios, which are the net profit margin and return on asset. These ratios will help us compare the financial performance and efficiency of both companies over the 5-year period. Now, let's begin with Sime Darby net profit margin. This slide presents Sime Darby net profit margin from 2021 to 2025, which measures how much net profit the company earned from every ringgit of revenue. As shown in the table, Sime Darby's profitability fluctuated throughout the 5-year period. The company recorded a net profit margin of 3.20% in 2021 before declining to 2.56% in 2022, mainly due to higher operating costs and weaker commodity prices following the COVID-19 period. In 2023, the margin recovered slightly to 3.02%, indicating gradual improvement in profitability. The company achieved its strongest performance in 2024 when the net profit margin increased significantly to 4.92%, reflective improved cost efficiency and stronger earnings from its pedestrian and motor business. However, despite recording the highest revenue in 2025, the margin fell to 2.64%, suggesting that increased operating costs and other expenses reduced the company's profitability. Overall, Sime Darby maintained positive profitability throughout the 5-year, although its margins were inconsistent. Now, let's move on to the Sime Darby's return on asset. This slide shows Sime Darby's return on asset or ROA, which measures how efficiently the company used its total asset to generate profits. Based on the result, the company's ROA also experienced fluctuation during the 5-year period. It started at 5% in 2021 before declining to 3.65% in 2022, indicating weaker asset utilization due to lower profitability. In 2023, the ratio improved slightly to 3.94% as the company's financial performance recovered. The highest ROA was recorded in 2024 at 6.38%, showing that Sime Darby generated the greatest return from its asset during that year, supported by stronger net income. However, the ratio declined again to 4.45% in 2025 because the total asset increased while net income decreased compared to the previous year. Overall, Sime Darby demonstrated relatively efficient asset management despite some fluctuation in performance. Next, I will present the net profit margin analysis for DRB Highcom. This slide illustrates DRB Highcom net profit margin from 2021 to 2025. Unlike Sime Darby, DRB Highcom experienced weaker profitability over the 5-year period. In 2021, the company recorded a negative net profit margin of negative 2.39%, indicating that it incurred a net loss and was unable to generate profit from its revenue. The company recovered in 2022, achieving a positive margin of 1.21%, which improved further to 1.51% in 2023 as net income increased. However, in 2024, the margin dropped sharply to only 0.14% despite higher revenue, mainly because net income declined significantly due to higher operating costs or operational inefficiencies. In 2025, the company showed a strong recovery by increasing its net profit margin to 2.30%, the highest level during the 5-year period. Overall, although DRB Highcom successfully recovered from losses, its profitability remained relatively low compared to Sime Darby. Next, I will discuss DRB Highcom's return on assets. This slide presents DRB Highcom's return on assets from 2021 to 2025, which evaluate how efficiently the company used its asset to generate profit. The company recorded a negative ROA of negative 1.50% in 2021 due to its net loss, indicating poor asset utilization. In 2022 and 2023, the ratio improved to 0.73% and 0.93%, respectively, reflecting gradual recovery as the company returned to profitability. However, ROA fell sharply to just 0.09% in 2034 because net income dropped significantly while total asset remained relatively stable. In 2025, the company achieved its best ROA of 1.59% following a strong increase in the net income. Although this improvement is encouraging, the ROA remained below 2%, suggesting that DRB HiCom still need to improve its efficiency in generating profit from its asset. This brings me to the conclusion of my presentation. In conclusion, the profitability ratio analysis shows that Samdabi consistently outperformed DRB HiCom between 2021 and 2025. Samdabi maintained higher net profit margin and return on asset, demonstrating stronger profitability, better cost management, and more efficient utilization of its asset despite some fluctuation. In contrast, DRB HiCom experienced greater volatility, beginning with losses in 2021 before gradually recovering over the following years. Although the company showed improvement in both net profit margin and return on asset by 2025, its profitability remains relatively low compared to Samdabi. Therefore, based on these two profitability ratios, Samdabi demonstrates stronger financial performance and operational efficiency throughout the 5-year period. That's the end of my presentation. Thank you.